2010. That would be the CRSP, the Center for Research on Stock Prices. The S&P 500 would just be the 500 largest companies. But the average of all U.S. mutual funds underperformed the market over that period of time. If you invested $100,000 in the beginning, it underperformed it by $1.5 million. If you look at the average of all equity funds. Now it's equity funds, it's not bond funds, okay? So this is all stock market funds, and the average of all stock market funds as compared to the market itself. So stock picking by mutual fund managers is not beating the market on average and not even coming close. If you look at all mutual funds on an average, now you're looking at bond funds, you're looking at international funds, you're looking at those emerging market funds, you're looking at small companies, you're looking at value companies, companies that are distressed, you're looking at all of those different kinds of funds, including the safer ones. And the average of all mutual funds, when you put that real information back in, it turns $100,000 into $1.2 million. And even the most conservative allocation of funds that we offer, which only has 25% allocation into stocks, would have beat it by 1.8 million. So when you take the dead funds and you put them back into the market, you get the real data, and stock pickers are not beating the market by anywhere near average. You'd expect some of them to win and some of them to lose. A few of them, maybe 30 or 40 of them are winning out of 26,000, or finding them ahead of time. And most of them, by and large, are losing by a great margin, if not just being killed for their lack of performance. Okay, so stock picking doesn't work. But when I got this information, and I was just telling someone recently how this progressed for me over the last decade, when I got this information on mutual fund stock picking performance, the thing I wanted to do right away was say, listen, I don't want to invest in the losers, right? I want to find the winners. And where do you find the winners? Anybody know how you find the winning mutual funds every year? What do they have behind their name? 5 stars, right? Morningstar's 5-star system. So you look at the 5-star funds. Some people call it the all-star managers, right? The ones that have done really well. And so we wanted to work with the winners, and that was the goal that we had. And we're going to move to page 6. I'll try to keep you up. Track record investing is then what you get, because the only and most used information for folks choosing mutual funds would be the track record of those funds. And the use of performance history to determine the best investing for the future is called track record investing. It's very commonly used, and sometimes it's not so bad, but it's got some woes in it as well. And the myth is that finding funds that did well in the past is a reliable method of finding funds that will do well in the future. Okay, that's a myth I'm going to purport to you. And here's the data to go along with it. Now here you're going to have to look in your book. And you're looking in for the life of me, I can't get this blue box to leave my screen for the first shot. So I want you to see in your book, from 91 to the year 2000, for that 10-year period, along the left, you see the list of the mutual funds that won, that beat the market. Okay? All of the names of the mutual funds, it gives the annualized return that they got for that 10-year period annually. And take a look at that Fidelity Cell Electronics. 34% per year for 10 years straight. Pretty amazing. Look below where it says the average return, or the S&P 500 average return, 18.39. If you had invested in the top 30 funds, you would have averaged 25% when the market got 18%. That's anecdotal evidence, right? That track record investing works, except for one problem. What's the problem? When did you get this list? You got it in 2000, right? Did you get the list in 1991? You know, they don't publish this list in 91. We don't know who's going to be the 34% winner for the 10-year period that's coming. We only know the ones that have done in the past. Now, these are the best. These are the winning 30 mutual funds. Let's look at their performance in the following 10 years. And you have to compare it to the market. So if you look at the bottom, the market, the S&P 500, did 3.6. The average of the best mutual funds the previous 10-year period was 0.43. Now, here's the other reality. After a mutual fund manager beats the market for 6 or 7 or 8 years in a row, their cost structure goes up. We see it on our reports all the time. Their expense ratio will go from something like 0.7 or 0.8 to 2 or 3%, right? They're beating the market like crazy. They're worth it. You can pay them 3 or 4%. You can still make 4 or 5% more than the market. Most of the money comes into these winning funds after they've had their good run and while their expenses are high. And we're buying them as the 5-star funds. And we buy them because they just beat the market by 5 or 6 or 7%. And then look at the performance after the period. After the period, they underperform the market and you're paying more for them. And now we've done this on a decade-by-decade basis for 20 years. And it's the same story. The next one that I'm going to show you in a minute is a little more complicated, but I'll show you the same story in there. The track record of these funds over the chunks of time that we're using to develop their track record, which is 5 and 10-year periods, that's what they produce, are not a good predictor of their future performance. Does that make sense? Mm-hmm. This is a key piece. What practically happens inside your 401k is that you go into your 401k office and you say, I want to invest in my 401k, and you choose 5 or 6 funds. You generally choose them based on the track record. And unfortunately, your 401k doesn't give you the top 30, they give you 15 choices, right? So they're not necessarily always the best, but you choose the one with the best track record. And then 3 years later, you like 3 or 4 of them because they've done relatively well, and you don't like 2 or 3 of them. So you dump the ones that did what? And you sell them when? Oh. And you buy the ones that have done what? And you buy them when? And then 3 years later, you get ticked off at 3 or 4 that had also done this. And you're constantly buying high and selling low. And this is the chasing after returns that happens in the 401k. And it's not even so much that the mutual fund manager has done poorly that many years in a row. It's that there's no real rhyme or reason for why you got into the funds you got into in the first place. And there's such fluctuation based on the market that we're constantly chasing after the return of that next 5-star fund, and that information is being propagated to us. And oftentimes what will happen is the 401k administrator, your plan sponsor, the owner of the company, will change the mix of assets that they offer to you based on the same thing. So a lot of times they're getting you out of 10 or 15 funds and suggesting that you get into 2 or 3 or 4 different ones based on the fact that those have done better than these the past 10 years, when that information is oftentimes the least relevant information available. So track record investing doesn't work. Let's look at this next one. This will be in your page on 7. It'll be on the screen in a readable way as well. This is a 5-year period. From 01 to 2005 is the 5-year period where we see these 30 funds, and they beat the market. And they beat the market like crazy. 22% return from the top 30 average. And the S&P 500 was 2%. Now, if you look at the names along here, what is the most common word to describe the funds as you look down the left-hand side? The words micro and small, right? And what did we say about the S&P 500? The S&P 500 is large companies, right? So in a period of time, when you have large companies and small companies, these are what they call low correlating assets. They don't generally move in the same direction. It's good to own both because generally one goes up while the other's going down, and you're getting some good benefits. I'll get into that later. During a period of time when large companies did poorly, had you been in the small company or the microcap company funds, you'd have done well. But you didn't get this list in 2001, you got it in 2005.